Greetings, members, one and all of the Salivation Nation. It has been a wild day for the markets, for silver, and for gold. Let's explore. Yes, indeed. Now, the numbers that you're seeing on your screen right now for gold and silver are not necessarily all that crazy, although it is unusual to see one metal move in the opposite direction of the other, therefore widening the gold to silver ratio again to almost 77 to 1. But nonetheless, that's what happened. We are seeing slight movements in gold in the upwards direction, almost a half a percentage point. And silver is down about 30 cents, just over a 1 percentage point, almost a 1.25 percentage point. So what's going on here? What happened today? Well, we had a wild day on the stock market, and we're going to cover that area first. The stock market had a amazing drop today, over 1,000 points for momentarily, pretty much reenacting what happened in March of 2020. And what did people do? They ran to the safety of cash, and that strengthened the dollar, essentially. Let's take a look at this through the eyes of CNBC and see what's going on here. I think it's a little bit interesting that we're seeing this movement in the market so quickly to drop 1,000 points and then recover almost all of it. It's crazy. Stock market mounted a dramatic comeback on Monday as investors stepped in to buy beaten up tech shares. The Dow Jones Industrial Average closed up 99.13 points, or 0.3%, at 34,364.5 points. It closed up at the close. That's amazing. Gaining for the first day in 7 days. So it had been dropping for a while, and now it's picking up. The S&P 500 finished higher by 0.3% at 4,410.13. The Nasdaq Composite gained 0.6% at 13,855, and the Russell 2000 index of small cap shares closed up as well. The Nasdaq Composite Index turned positive after being down as much as 4.9% earlier in the session. The Dow rallied after being down 1,115 points at one point. The S&P 500 closed in the green after briefly hitting a correction earlier in the session, falling more than 10% from its January 3rd record close. Monday ended up being one of the best market comebacks in quite a long time. The session marked the first time since the aftermath of the financial crisis in 2008 that the Nasdaq Composite had been down more than 4% intraday and closed up. For the Dow, which was down 3.25% at its low, it was the biggest comeback since the wild trading of March 2020. Yes, indeed, something to see. I was here all day. Actually, I'm home. You probably can tell. I've got a little bit of a cough here. It is a COVID cough, so I'm going to be down and away from work for a while. So I'm watching these markets, and it's been interesting to see what's going on here and this crazy comeback that we're looking at here. What is involved in that? One can only guess, but I know what some of those guesses are, that perhaps it's been propped up. We'll see. Nonetheless, J.P. Morgan's top stock strategist Marco Kolonakov said in a note Monday that the sell-off in equity markets was overblown. Okay, there you go. Overblown, he says. The recent pullback in risk assets appears overdone, and a combination of technical indicators approaching oversold territory and sentiment turning bearish suggests we could be in the final stages of this correction. Kolanovic said, while the market struggles to digest the rotation forced on it by rising rates, we expected the earnings season to reassure, and in a worst-case scenario, it could see a return of Fed put. Investors began Monday's session dumping technology shares, as they have all month, on fears the Federal Reserve would soon aggressively tighten policy. We'll hear more from them later to see if they're going to actually do it in March More likely, all indicators point to yes. Moreover, those shares rebounded as the day went on, with Facebook parent Meta, Amazon, and Microsoft closing higher. Monday's pullback still put the S&P 500 down 7.5% this month, on pace for its worst monthly performance since March of 2020. The rout this year initially centered around the Nasdaq and technology stocks, but investors rotating out of shares whose evaluations look less attractive as rates rise. The market action Monday followed a brutal week on Wall Street in the face of mixed company earnings. Selling may have reached a capitulation point, with the CBOE Volatility Index, known as the Wall Street as the market's fear gauge. We talked about fear in a prior video, hitting its highest level since November of 2020, surpassing the 38 level at its intraday highs. Once the fear gauge hits those examples, the market has a tendency to snap back, even if only temporarily. Investors are eyeing the Fed's policy meeting, which begins on Tuesday and wraps up Wednesday. Market participants will be looking for any signals on how much the central bank will raise interest rates this year and when it will start. The greatest fear is how the Fed reacts and keeps this balancing act. And Miletti, head of active equity at Allspring Global Investments, told CNBC Squawk on the Street on Monday, there's going to be a lot of turbulence as we march through the next couple of months. The FOMC, which sets interest rates, is meeting with expectations that it will not act at its January meeting, but will tee up the first of multiple rate hikes starting in March. In addition, the Fed is expected to wrap up its monthly asset purchase program that same month. At its post-meeting news conference, Chairman Jerome Powell could also signal when the Fed will start to unwind its mammoth balance sheet. Goldman Sachs said over the weekend that it sees risk rising that the Fed could enact even more than 4/4 percentage point hikes in the market has priced in for this year. The firm also said that the Fed might start running off the nearly $9 trillion in assets in its holding in July. Investors also monitored geopolitical tensions as Russia built up its military presence at the Ukrainian border. And we know that Joe Biden is set to speak with European leaders sometime today amid fears of a possible Russian invasion in Ukraine. In fact, they pretty much have resigned to the fact that it's probably going to happen sooner rather than later, and that is a big concern too. And I think that is in part what led to some of today's reaction, which could have been an overreaction. My guess is that what we are seeing today is going to be baked in that if Ukraine does get invaded by Russia, there may not be as much of a panic. We'll see, but it's anybody's guess here as we look at these prices here, as we monitor them here. So what is the deal with silver? It did drop. Gold rose and silver dropped. They've been choppy in this article from fxstreet.com, with prices recently collapsing back to the south of the $24 level towards $23.80, with the precious metal now trading lower by about 2% on the day. Silver is seeing divergence with spot gold on Monday, and the latter seemingly catching a bid amid safe haven demand as a result of geopolitical concerns, while the former fails to do so. Silver could be suffering as a result of a broadly stronger U.S. dollar, which, like gold, has been gaining on safe haven grounds. The recent bout of selling pressure has seen the dollar index hit its lowest level since last Wednesday. The bears will be eyeing support in the form of the 25 November highs in the $23.70 area ahead of the potential retest of the late December highs in the $23.40 area. Silver does hit these levels. The big question will be whether the recent pullback has sufficient to attract dip buyers. I think a lot of this stuff is kind of a moot point. I don't think there's any targets or any floors or any ceilings now for either metal, because there's a lot of volatility in general markets that could happen again. We could see another big drop tomorrow. That this could be just a reprieve of the gains that we've seen today. I don't know. It just seems everything seems very volatile and on edge everywhere. it seems. And it's not just with Russia and what's happening in Ukraine, but it's also just exacerbated by everything that's going on with the Omicron variant, with people's confidence in the presidency right now, and America in general, and their economy. It certainly is under pressure right now. And so there's a lot of different factors that are coming into play here. Ahead of this week's Fed meeting, which is unanimously expected to be a very hawkish affair, the appeal of interest rate sensitive assets such as precious metals may be somewhat limited. Geopolitics and overarching risk appetite will, of course, also be important drivers of silver this week, and the U.S. data in the form of the fourth quarter GDP and December core PCE inflation will be worth watching. And I want to go ahead and throw something out here which could possibly happen. We very well may see them announce a rate hike tomorrow of a quarter point. Or not tomorrow, but whenever they make the announcement or see here. They may do that a little bit early as part of their hawkish move to go ahead and start a little bit early with it. Inflation numbers that we've seen, up 7% for the last measure over year inflation, is concerning. You know it's going to be concerning for the Fed, so they may try to even go ahead and do this now for a 0.25% rate hike when they meet this week. That could happen. I'm not going to predict that it will happen, but I'm not leaving it out of the realm of possibility, because I think that given what we saw today with the stocks going crazy and falling over 1,000 points, that has got to rattle the nerves of the chair of the Federal Reserve and the Board of Governors, indeed. So we'll see. So that very well could be the case where we see the Fed act sooner rather than later on those rate hikes. We'll find out for sure. And of course, if that does happen, be prepared for a smackdown for both gold and silver if that does occur early, because that's going to be a shock and a surprise, and that's going to strengthen the dollar, at least at the very beginning. It will. We'll see how it works out, how it pans out. Either way, we'll keep an eye on it. Let me know what your thoughts are in the comment section below. There's your market report for the day. I'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.